Greetings, traders, and welcome back. Thank you for joining me again. My name is Chris, and I will be your host today as we go through another in-depth with Chris episode. We're going to be discussing what stock futures are, as well as covering some of the information that you should be made aware of before you get started trading stock futures, or if you're interested in trading stock futures. A lot of traders out there are well aware of what stocks are, but then they don't realize that a lot of stocks can also be traded in future form. We have indexes out there like the E-mini S&P 500, which is incredibly popular with a whole lot of power behind it, and that too can be traded in future formation. So without further ado, let's dive on into it. The stock futures market is one of those weirdly hidden in plain sight markets. Everyone's aware of what stocks are. Even non-traders have heard of the DJIA, the Dow Jones Industrial Average, the FTSE or the DAX, the CAC 40, and a bunch of others. It's easy to recognize all of these things, but a lot of people are just not aware that we can actually trade all of these different indices with a futures contract, which adds a lot of different benefits, and we're going to cover all that. So what are stock futures? Well, stock futures just fall under a category of futures contracts that are used to trade stock indices. So it is futures of stock indices in the short. And what they do, these indices that is, they bundle different shares of different companies based on specific criteria. The idea is that it's supposed to make it easier to look at trends on the overall market based on the index's overall level. This is why stock or equity indices are often used as a suitable measure of an investor's sentiment in whatever specific market that we might be analyzing. An example of this would be if we were to look at, say, a technology stock index. That technology stock index would track a bundle of technology stocks, and it will move with the overall performance of the stocks within it. The idea is that us as investors can use that index to quickly gauge the performance of technology stocks as a whole. Either in the present or over a specific period of time, we have the ability to analyze stocks in this manner when we take a look at these indexes. Stock index futures have been on the investment map since they were introduced sometime in the early 1980s. The first stock index future was launched in 1982, I do believe. Institutional traders originally used them as a hedging instrument to protect against sudden price reversals. The use case has then since evolved to being more used like a speculative tool among day traders, and that's where the E-mini S&P 500 and the likes of those come in. They are also used to arrive at the pricing for just CFD index futures. Stock future knowledge can even lead to predictive qualities about overall market movements. And this is because stock futures exchanges like the CME typically have longer trading hours than regular exchanges. There are also some futures contracts that are traded around the clock. This makes them useful for predicting where a stock index might move next, or at least where speculators think an index will move by the time the underlying exchange opens for the day. A good example of this is if we look at the FTSE 100 index futures. These futures contracts are traded from 1 a.m. to 9 p.m. London time, while the regular hours for the FTSE 100 market itself are from 8 a.m. to 5 p.m. So in this way, any news that we were to find coming out outside of the period of the normal FTSE market can influence the trading sentiment before the market opens. And if you are feeling incredibly predictive and accurate in your forecast, make sure you check out the Gauntlet Mini because it provides a strong platform to prove your skills. Before we further explain how stock futures trading works, it's essential to understand the structure of index futures contracts. Entering into an index futures contract means both parties are bound to an agreed value for the underlying index to be settled at a specified future date. So this basically means that traders have the obligation, not the right as with options, to settle the contract at a future date. Once again, that means they have the obligation, not the right, to settle the contract at a future date. It means it is happening. The value of a stock index contract is specified by the exchange where the index is traded. Like any derivative, stock index futures are a zero-sum game. One party takes a long position and the other party takes a short position. There's no physical underlying asset to deliver, so index futures are always settled in cash. At the time of the settlement, the loser pays the winner the difference between the agreed index futures price and the closing value of the index. So make sure you are the winner. So now we're going to take a moment and talk about some of the exact trading implications that are involved with trading stock futures contracts. We can trade stock index futures through a commodity futures broker, pretty much any commodity futures broker out there, and it's their job to facilitate the trade on both the buy and the sell orders. We want to make sure that the platform that we're using is reliable and that we can also afford their margin requirements. These are two pretty crucial things to remember. And if you're ever in doubt about whatever broker it is that you're intending to use, make sure that you visit the National Futures Association, which we usually refer to as the NFA. Terrible handwriting continues to be a thing with me. But to vet any potential brokers, we can go here and check them out. So we want to check out their futures trading fees, the complaints lodged against them, and we can also track their records in generating fair, clean stock futures trades. Just like trading traditional stock market securities, a buy order means taking a long position, which profits from a rising stock index, where a sell order results in a short position, and to realize profits, we have to have a declining index. And like we previously discussed, a stock index future is purely cash settled, since there's no possible way to physically deliver an index. I can't hand you the S&P 500. The settlements also occur daily on a mark-to-market basis. Like other futures contracts, traders are required to put up an initial margin to enter a position in the index futures. There's also a maintenance margin set for each contract, and the value must not drop past a certain point, or the broker will initiate what we call a margin call, and nobody likes margin calls. That basically means we need to add more money to our account to keep our position open. And also, if the futures market seems a tad too complicated, it's worth noting that we could also consider trading things that are known as ETFs, which the long word is exchange traded funds. They offer similar exposure as stocks without having to deal with the relatively high risk typically associated with standalone stock index vehicles that are out there as well. We should also discuss how calculating profit, or loss for that matter, works in the stock futures world. So the opening value of a futures trade is the price that we paid for the futures contract when we placed the trade. The resulting profit or loss is then calculated from that value. So to determine the size of our profit or loss, we need to consider the number of futures contracts we traded in that session. We also need to consider how much each contract is worth per point of movement in the index. So per point of movement is going to determine really where that profit's coming. Now let's say we use an example with one of the more popular indices out there of the S&P 500. And we'll talk about this example using a full-size contract, which means it has a set value of $250 per point. So we know the index is valued at 2,600 points in this particular example. That's because I have it written down, and in this situation I am now God. Then it's going to be worth a $650,000 contract if we were to buy one contract, because 250 times 2,600 means 650,000. So if we assumed that the index is sitting at that 2,600 points when we bought it, and we know that it's worth that 650,000 points. Well, if we buy a contract with 10% margin, that means that we owe 65,000 if our margin requirement is 10%, of course, because 10% of 650,000 is 65,000. So that's what we need to get the trade going. So if we were to say that the underlying index of the S&P 500 were to swing somewhere of, like, say 20 points, then we would have the potential to gain, say, $5,000, which would be 5,000 coming from 250 points, this guy here, and multiplying that just simply by 20. 250 times 20 equals 5,000. But whether we're making profit or whether we're losing is going to be determined on whether or not we were correct with our forecast. So it doesn't really become a whole lot of difficult math in calculating the contracts. This is basically it in a nutshell. It doesn't get a whole lot more complicated than this. I know my voice is just very, very exciting, and you're probably sitting there saying, "Oh, Chris, won't you just talk some strategy to me?" Well, you're lucky. I actually will. So, number one is going to be our bid ask scalping strategy. This is, once again, not in any particular order, but out of the strategies that are employed today, these are three of the most common. Scalping is one of the quickest strategies that's employed, and it's done by exploiting various price gaps in bid ask spreads and order flows. The idea is it's supposed to give ourselves an opportunity to take advantage of a discrepancy when the bid ask spread gets too far apart, and we're trying to buy at one when it gets a little too low or sell at another when it gets a little too high, and take advantage of the distance in between the bid ask spread. It's relatively simple in that nature. Then we have the buy and hold strategy. The buy and hold strategy is quite literally what you would think. It's taking advantage of long-term grindy indexes or indices out there, such as the S&P 500, that are stably showing somewhere around 9 to 10% return annually. That's where it's been at for quite some time. And the idea is we're just looking to take advantage of buying and holding for a long period during any particular downswing in the market. So relatively simple concept there, just taking advantage of the long-term trend, a lot more like a swing trade there. Then we have the fundamental technical analysis side of things. So with fundamental and technical analysis. So fundamental means we can analyze certain reports and get an idea of what's going on with different companies in the index that we're interested in on, and use that information to get an idea whether we should buy or sell before maybe an earnings report comes out, because we anticipate the index to jump up due to some positive news or vice versa. The technical analysis side of thing is exactly what we're used to with any other facet of trading. So that just means we're going to analyze historical price data and use our Japanese candlesticks to get an idea on whether or not the market is going to be going lower or higher based on various things like support and resistance. If you aren't already scrambling at the bits here to jump into some stock index futures trading, here are some other benefits we should discuss. The first one is going to be the leverage. So leverage in opening a futures position means that we get to enjoy a bigger total exposure when the capital that we actually have isn't that large. So we refer to this capital that we have to put down as a margin requirement, and it usually ranges somewhere from, say, 3 to 12% of the contract value. It depends on the contract as well as where you're trading. But the idea is that we can make more money with less money. Our second little benefit that we have here is going to be liquidity. Futures markets themselves tend to be very liquid, which makes them easier to trade than a lot of other markets out there. Price movements tend to remain fairly stable too, especially as the futures contracts near maturity. Then we have hedging. If our portfolio contains a number of stocks that are part of a single index, we could hedge market-specific risk. We might do this if we're concerned about systematic risk. This is the risk that the overall market may decrease in value. So we could hold a short index futures position that could offset the stock risk. If the index does fall in value during a market downturn, our futures contracts will earn a profit, and the profit could potentially counteract the losses from our individual stock positions. But remember, just like an elephant would, we have risks that would be associated as well that we should mention. Nothing too crazy, but always going to bring it to you full and clear. The first is going to be leverage risk. And you might be saying, well, Chris, didn't you just say that was a benefit? Well, it absolutely can be. Leverage is always a double-edged sword. It can help us gain more money quicker, but it can also help us lose more money quicker. So it can magnify whatever direction the trade is going. So it can be counted as a benefit and as a potential negative. Then we also have cash and margins. So when we are on the topic of cash and margins, we have to understand that to participate in the futures markets, we need to put up an appropriate amount of margin as required by the exchange and the broker. And this means that if our trade experiences a significant loss and we get margin called, we have to top up on our account in order to keep our position from being liquidated. It's neither here nor there, but once again, it falls more in the negative side than anything, so it is worth mentioning. So in conclusion, stock futures are obviously not going to be for everyone, but it allows us to have access to some pretty cool tools. It gives us the ability to hedge our portfolio if we do have a stock portfolio, and it also allows us to trade a fast-moving liquid market, which if we are traders, those are some of the things that we're always looking for. The E-mini S&P 500 is one of my personal favorites, as I'm sure all of you are well aware because I blab about it quite a lot. But if you do think you have what it takes, guys, to pull off some serious success, I want to see you in the Gauntlet Mini, so make sure you check that out. But until next time, everybody, please make sure you click the like and subscribe button below, and I will see you all very soon. Cheers, everybody. Over and out.